The Real Investment Show.
And welcome back to the show this morning. I'm Real St. Roberts, Brent, Clanton, joining me as well, of course. And a few things to get into this morning. We have a new article out on our website this morning, and it's talking about this whole idea of this fiscal pig and the economic python. And the point of the article is discussing this $5 trillion worth of liquidity that was injected into the markets. And again, while there's a lot of hope here that markets can continue to rally, one thing you've got to think about is just the reversal of what got us here, right? And this is the one thing I just kind of continue to think about a lot. And again, as we talk about here, is there a possibility that the economy can avoid a recession this year and earnings maybe come in better than expected, right? They're not as weak as expected. I mean, sure, those are all possibilities. And I think you have to give some credence to that. There's, there's a lot of very bearish comment out there that's simply, the market's going to go down and we're going to have another negative year. And that's certainly, I can make a very strong case for that, right? The Fed's hiking rates. Fed hikes rates, they always cause a recession, et cetera, so forth and so on. But I think we have to also think about the other side of that coin as well. When everybody assumes something, right, you have to make room that everybody is potentially wrong, right? Because that's the way markets work. What markets are looking for are these kind of displaced opportunities. So if everybody is short the market, right, then that provides a lot of fuel for a counter trend rally of magnitude. And that's why markets tend to do the opposite of what everybody thinks. And there's a lot, this is why contrarian investing works over time, is because when everybody's on one side of the boat, typically whatever's happening, or what will come is on the other side. And this, a good example of this was everybody hated energy in 2021. And nobody wanted to own energy stocks. It's not clean energy, and oil prices were low, and blah blah blah. Right? Nobody wanted them, and we were talking about energy stocks would be a good place to be because everybody hates them, and they turned out to be a good place to be. And the question, of course, now is as we move into the new year, where do you want to be? And right now, everybody wants to be out of the market. I don't want to be invested. I don't want to own stocks. I want to own, gold and other stuff. And that's fine. Nothing wrong with that. I'm not saying that that's not the right place to be. I'm just throwing out this idea that if everybody thinks that, what is the counter trend trade? What is the contrarian place to be? And, so there's certainly a lot of comments out there right now about how bad things are going to be, but there is a possibility that they're wrong. So what would that be, right? That would be an economy avoiding recession. That would be earnings not coming in as bad as expected. And that's an argument that is very tough to make data-wise. And part of the discussion that we're having today in the blog post is talking about this $5 trillion worth of liquidity that we shoved into the system that's now working its way out of it. And there's no more coming. And it was interesting because if you didn't pay attention to this whole McCarthy issue that was going on, and so they were trying to elect the Speaker of the House, and it went through 15 votes in order to finally get Kevin McCarthy elected Speaker of the House. And without that, it's like, well, what's important? Well, without that, you can't do anything. Without a speaker, you can't pass any legislation. You can't have any appointments to committees, nothing, right? That all goes through the speaker. So you have to have a speaker. I mean, everything's dead until you elect a speaker. And so for 15 rounds, we go through this whole drama. And, you're sitting back going, what is going on here, right? What is happening? Well, turns out that there were a group of Republicans that were actually working in your interest. And they did a very good job. And what they did is they, in order for Kevin McCarthy to get their vote, they had to reverse all the rules of how the House works back to before pre-Obama. After Obama got elected and Nancy Pelosi, they changed all the rules to make things much easier to pass these kind of omnibus spending bills, right? These $1.7 trillion monstrosities that create these funding issues. And that also is part of this process, because now what these rules state is that, you know, every bill has to be a singular bill, right? If you want to pass money for funding, you know, a particular economic project, that's it, right? You got to have a bill for that. You can't have that bill and then 4,000 other pieces of funding shoved into that bill at the same time, right? So it's just getting Congress back to working the way it's supposed to work from a fiscal standpoint. So it just really returns a lot of the congressional rules back to the way they were supposed to be and the way they were intended with the Founding Fathers. So it's actually a very good thing that occurred. Here's the bad thing. You're not going to get any more of those $1.7 trillion spending bills. One of the things that they passed, and one of the things we've talked about here on the show quite a few times, we haven't had a budget since 2008. 2008 was the last budget we had, and this is part of that rule change, right, where we started just doing these continuing resolutions. Every time we got to a debt ceiling, we just passed a continuing resolution that automatically increased spending for the government by 8% and blah, blah, blah. Kept running up our debt, right? $31 trillion. Can't do that anymore. Part of the agreement for Kevin McCarthy was to go back to a budget process. Amazing. What that means, though, is you're not going to get checks to households. You're not going to get another $1.7 trillion worth of funding, right? It's just, that's not going to happen. So all this kind of runaway spending is going to be put under tap here for a bit, which means that all that liquidity that was injected into the economy is now going to come out at a time where the Fed is hiking interest rates and doing quantitative tightening. This is going to be more problematic in terms of generating earnings growth, considering that earnings growth have to come from economic growth. And so all of this lack of liquidity, this lack of capital in the markets, this retraction, combined with higher interest rates, that's going to slow economic activity. And it's going to slow demand. And as you have slower demand, that's where earnings come from. So there's going to be a risk here, and I think a viable risk, that earnings come in weaker than expected over the course of this year. And look, expectations are coming down. Earnings are coming down. They haven't come down enough yet. We've talked about this on the show quite a few times. But earnings have to fall because the economy is going to fall. Now, that doesn't mean we're going to be in a deep, dark recession and you need to be in, a bunker with beanie weenies and ammo. I'm not saying that, but, avoiding a recession is going to be a challenge. Can it be done? Sure. I'm not sure how it's done, but it's possible we could avoid a recession. Look, nominal growth is still, on the economy is still fairly high. So you've got to cut a bunch of economic growth because of the nominal increase that we had in economic growth in 2020 and 2021. You had this huge surge in economic growth because of all that stimulus, right? All that's got to come back out again. So you've got a long ways to fall on a nominal GDP basis just to get to a recession. And then, of course, the question will be, at what point does things start to kind of stabilize? We get back to some level of normal. This is going to be the real challenge this year. So I think you have to build in the case for both models. You've got to build in a case for, again, it's a very easy case to make that you're going to have a recession, right? And you're going, well, Lance, then why be in stocks, right? Because we're going to have a recession. Problem is everybody thinks that. And there is this contingent of the market that still is bent over backwards trying to hope for, the Fed's going to give up any moment now and start pivoting and putting capital back into the markets, and markets are going to run off, and I don't want to miss the bottom. People are piling into the most risky assets again, emerging markets, international markets. Those, emerging markets in particular, they've been doing well this year so far. Coming right out of the gate, emerging markets are doing well. That's a very risky bet. Because if we have a recession here, we've talked about this before, because emerging market economies are exporters, their whole economy is based on exporting goods and products and services to where? The U.S. and other industrialized international countries. So if their entire economy is based on exports, that means they are dependent on what? Demand. If demand in the U.S. falls, in other words, if we get a cold in the U.S., they get the flu. So you got to be careful chasing emerging markets and international heading into a recession. It's not where you want to be. If we avoid a recession and demand stays high, they're probably going to outperform. So there's your conundrum, right? There's your risk. So these are the things that you've got to work through. And again, this is, I think there is one very clear, and this is the point of the article today on the website, realinvestmentadvice.com, is this whole discussion of monetary flows. This drain of liquidity is extremely important. The ramifications of that draining of liquidity is equally important. And I think that's the one thing, you've got to pay attention to this year is where the money flows are going to and where they're not. That's on the website now, realinvestmentadvice.com. We'll be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
A couple of things are happening up in Congress now with the new Congress in. One of those have now set up the potential for a defunding of the IRS because under the previous funding bills of the Biden administration, they had provided a lot of funding to the IRS to hire like 87,000 IRS agents to go after the rich people, right? But of course, it's never the rich people that get tagged. It's always the middle class or under that wind up paying the bulk of the taxes. So part of this, though, is a defunding of those 87,000 IRS agents, which, a lot of individuals got a job and now they don't have one. So we'll see what happens with that. But, this is something that, unfortunately, it's now January, which means that tax day is rapidly approaching. April the 15th will be here before you know it. And inflation, and the IRS is trying to figure out how to help with inflation. And I'm just curious exactly how they're going to do that, Danny.
Well, each and every year, the IRS does make adjustments to tax brackets. So this year, they did make an adjustment a little bit more hefty than usual. So they actually gave a 7% adjustment in increasing the tax brackets. So if you had to pull more money out, you're retired, or maybe you made more money, it's a positive thing in that aspect, in the sense that you're going to have a little bit more bandwidth before you reach that next tax bracket.
So in other words, if it just easy math, if the tax bracket was, say for
100,000,
25%,
it went to 107.
To 107, that's
Yeah.
right. So it's an extra $7,000.
So this is good news, but I think that, look, this is, it's not like, everybody acts like, woohoo, this is fantastic. But, it's minimal, but they all add up. So it's a little bit at a time. And so I think the important thing to remember is, and one thing that when we talk to a lot of people, is that they don't understand what their effective tax rate is at the end of the day. And so, we talk about the tax brackets in general, and a lot of people think about, when they talk about marginal versus effective, marginal being what that actual number is. And so, like, if you're in the 25% tax bracket, for instance, like you mentioned, or 24, then you would actually, what are you actually paying in taxes? You might only be paying 15 or 16%, which would be your effective tax rate. So it's just what your last dollar is taxed at is essentially what that marginal tax rate. And that's what many people equate to, saying this is exactly how much I'm paying in taxes. So for instance, easy math, if you said, I'm in the 24% tax bracket, and it was at $100,000.
Right.
Everybody would say, well, I'm paying $24,000 in taxes. Well, that's not necessarily true because you're going through many other tax brackets, which essentially you're taking the average of that.
Right, and you're also taking your
deductions,
standard deductions
yeah,
and charitable donations and all that. But I mean, yeah, it's kind of rough math. Back of the envelope thing is like how much you can pay on $100,000. It's once you get over that, of course, you get into the higher tax brackets, and everybody just kind of. But this is where we always get into these big debates about taxation and who pays the taxes and all that. So when you actually look at the breakdown of who all pays the taxes, the top 10% of income earners pay about 80% of all the taxes. And that's because once you start getting down to the lower brackets, the bottom 20% actually make money from the government every year. They pay no taxes and they get tax credits coming back to them. So they actually wind up, getting money. And this is part of that distribution effect that we talk about. And that, the U.S. is actually one of the countries that have some of the highest redistribution of wealth in the world, because you're taking money from higher income earners and giving it to lower income earners. And there's a lot of debate around that issue, but it's when people say, well, the rich need to pay their fair share. They actually do. Where we get hung up on this is when you talk about a company like Amazon as an example that paid no taxes. They pay a lot of taxes. They just didn't pay income tax because of the way the tax code works. But they're paying taxes on income, they're paying taxes on dividends, and then everything gets double taxed as well. Remember, when you get a dividend from the company, a company pays taxes on the income, and then you pay taxes on the dividends. So there's a lot of double taxation that actually occurs through the economy as well.
Well, you have to remember, many of these states and municipalities, they give benefits and subsidies to entice these companies to come over as well. So when you see these companies shifting from one state to the next or city to city, a lot of times there's some type of tax incentive involved. And so, but you think about the economic redistribution, and that aspect is that is actually helping your county, your area, because more people are going to be hired. You're going to have more jobs, which will create more people coming, which is,
well, look,
neither maybe good or bad, right?
Yeah, well, Citadel Securities, right, which is the evil nemesis of the financial markets, because they're basically the people that front run all your trades. With high frequency trading, they moved out of Chicago because of taxes and politics, and they moved to Florida.
Yeah.
Right. And so now they're bringing all these jobs to Florida, and they're building a massive high rise to house Citadel in. So that's going to be more property taxes for Florida. That's going to be more jobs for Florida, more income. So, there's to your point, there's a lot of, yeah, sure, I give you a benefit. I give you a tax break to come move your business, but all those employees now have jobs in Florida. They're going to buy houses. They're going to buy furniture. They're going to buy cars. They're going to buy food. They're going, think of all the stuff, all those employees,
all the jobs
now
that are created, not just with those employees, but the people that are going to service those people as well.
Exactly. So, there's going to be a lot of other revenue that comes in, and that's why these states do that. That's why you'll see, that, hey, come move to Texas, come move your business to Texas, and we'll give you 7 years of no taxes, right? State makes a lot of money, even with that gift.
Yeah, so, just in sales tax, property tax. I mean,
exactly.
There's so many other ways they make money. But you did mention something earlier. So talking about tax brackets, and we were just discussing how that you're going to get a 7% bump in tax brackets this year. You also did get an increase in your standard deduction. So that actually went up to $27,700 this year for a couple. So if married filing jointly, that's a pretty nice little increase. Yeah. Look, any of these things help. And what we found, though, with standard deduction increasing the way it has, and limitations on SALT deductions, so state taxes, your property taxes, those things, more and more people are using the standard deduction. So this is actually nice.
Right. SALT is standard and local taxes, so sales tax, those type of things.
Yeah.
So, and again, this has been one of the that was also one of the kind of inputs in the bills under the Trump administration. They started repealing the SALT tax in states like California, which was interesting because we don't have a state income tax. They do, right? So California.
Correct.
This is the problem with SALT taxes. Texas, as an example, doesn't have a state income tax. And so we basically wind up subsidizing taxpayers in California because they get a deduction for their state income tax against their federal taxes. So it's just kind of an interesting...
Whereas we get limited on the property taxes that we can deduct, right?
Exactly,
up to $10,000.
Like $10,000, yeah. Yep. And that did go up. They did adjust that up. And this session, by the way, in Texas, Dan Patrick, of course, who's the lieutenant governor here, is pushing. He's been kind of pushing very hard on reworking property taxes in Texas. And right now, Texas has the largest budget surplus of any state in the country. And so this is going to be the year that they're really going to push to try to adjust property taxes in Texas, because they have gotten a bit out of hand.
Yeah, they have.
These 8% annual increases in property taxes a little bit out of touch. So
yeah, but they've tried to push this through before. I mean, what do you think is this realistic?
Well, look, you've got a divided house in Texas as well. So it's not going to. There's a reasonable possibility it won't pass again. They've tried to pass this before and have been unable to do it. But with such a big budget surplus, this year may be a year where they have a better shot at it. Yeah. So we'll see.
That would be nice.
Yeah. Yeah, that property tax bill ain't cheap in Texas. I mean, people go, yeah, I'll move to Texas because they don't have a state income tax. Yeah, we have property taxes.
Mud taxes.
They ain't cheap. Yeah. So anyway, speaking of all this, of course, when you get into taxes as well, you're talking about income. And, on a regular basis, there are articles that are written about, well, how much do you need to be considered wealthy in the U.S. and how much do you need to retire with an income stream in the United States, et cetera. And, these are all great, right? And I saw an article yesterday as an example. Is like, if you make $100,000 a year, and right off the bat, if you go take a look at how many people make $100,000 a year, it's not that many people. Yeah. But if you make $100,000 a year, how can you save $2 million by retirement, right? And so it's the typical very back of the envelope.
Typical growth fund, and you make 12% every year, and it never goes down. And
you say $50.
$100,
yeah, you say $50 a month, and you get 12% a year for 30 years. You'll have $2 million.
If I had a penny for every story I've read like that, I'd be retired.
And it sounds great. Those things, they sound great. They're encouraging. They get views because everybody wants to have $2 million in the bank.
Of course.
Right? But will that do the trick for you? That's going to be the question.
And at what age, right?
And at what age?
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.